Here is a number that will reorganize everything you believe you know about selling silver: 28%. Write it down. Commit it somewhere it cannot be lost, because almost no one tells you this number before you sell, and almost everyone who discovers it learns about it the same way, on a tax bill they did not see coming. There is, somewhere in America today, a retired man staring at an invoice that cannot be made to compute. He did not gamble. He did not speculate recklessly. He observed over more than a decade of careful attention that the dollar was being managed in ways that a prudent man might reasonably distrust. He watched inflation accomplish month after month what no legislative body formally authorized. He watched debt ceilings that no longer appeared to constrain anything become simply the ambient condition of modern governance. And so he did what people with a certain temperament have always done. What people have done, in fact, for 4,000 years. He bought something real, something finite, something the Treasury cannot create by pressing a key. He bought silver, stacked it with patience, and when the price moved meaningfully this year, he sold. Then the tax bill arrived at $23,000 when he had budgeted for $12,000. That $11,000 gap is not a punishment for misconduct. It is the arithmetic cost of information not possessed before a decision was made. Understanding why it exists requires understanding how the Internal Revenue Service actually classifies what he owned, and the answer is one that the precious metals community, for reasons that speak more to human nature than to deliberate concealment, tends not to emphasize. Physical silver is not, in the eyes of the federal tax code, an investment asset of the conventional kind. It is not treated like equities. It is not treated like index funds, bond instruments, or real estate investment trusts. Physical silver, along with gold, platinum, and palladium, is classified by the IRS as a collectible. That precise word, collectible. The same statutory category that governs fine art, antiques, rare coins, and wine collections of sufficient value. It is a categorization that, once you understand it, reveals a certain institutional philosophy embedded in the code, a philosophy with practical consequences measured in thousands of dollars per transaction, and different rules collectibles receive. The maximum federal long-term capital gains rate on collectibles is 28%, not the 15% that circulates in most financial planning conversations, not the 20% applied to higher earners on standard long-term gains, 28%. For a stacker who has held silver for more than a year and finds the collectibles rate applicable, the tax burden is nearly double what careful, optimistic planning assumed. The code offers a qualification worth understanding, though it provides less comfort than it first appears. If a taxpayer's ordinary income rate falls below 28%, that lower rate applies instead. The 28% is a ceiling, not a mandatory flat charge. But here is the mechanism that collapses that comfort. Silver gains are added to a taxpayer's total income for the year in which the sale occurs. The sale does not exist in a separate compartment, isolated from your pension, Social Security income, dividends, and other earnings. A moderate income profile before the sale can become, after the sale, an income profile sitting comfortably inside the 28% range. The transaction generates the income that triggers the higher rate. The trap is self-constructing, and the IRS did not design it accidentally. For metal held fewer than 12 months, the situation worsens. Short-term gains on silver are taxed as ordinary income, which, for meaningful earners, produces rates of 32, 35, or 37%. Selling silver purchased recently is among the most expensive discretionary financial decisions available to an American taxpayer, and the IRS will not deliver advance notice of this fact. The agency operates with institutional patience. It will wait for the transaction to complete, allow the proceeds to be spent, and then it will send the bill. Now consider what 2026 specifically contributed to this landscape, because two changes arrived this year that most silver investors are entirely unaware of, and both carry real implications for anyone holding a meaningful position. On February 10th, the IRS issued revised instructions for Form 1099-B, the document dealers use to report precious metals sales, removing a specific example from the precious metals section and establishing in its place a formal aggregation rule for dealer reporting. In plain terms, sales made to a single customer within any 24-hour period must be combined and treated as a single transaction when determining whether reporting thresholds apply. If you have encountered the suggestion that distributing a large silver sale across smaller transactions might affect what a dealer is required to report, the IRS has now addressed that idea in writing. The door is closed, deliberately and on record. One point demands immediate clarity. Dealer reporting and personal tax liability are entirely separate matters. A Form 1099-B is an information return, not a determination of what you owe. The absence of such a form from a dealer does not reduce, excuse, or eliminate your obligation to report and pay taxes on a gain. The IRS has maintained this position for decades without ambiguity. No form does not mean no tax. It means only that the information trail is slightly thinner, a condition the agency is actively working to remedy through other channels. The second 2026 development arrived at the state level and carries the particular significance of a trend in motion. On January 1st, Washington State eliminated a precious metals sales tax exemption that had been in continuous operation since 1985. 40 years of protection for Washington buyers, the ability to purchase silver and gold without paying state retail sales tax on the acquisition, ended in a single legislative revision. The combined sales tax rate in Washington now ranges from 6.5% to 10.3% depending on county. A $10,000 silver purchase in Seattle carries a front-end tax burden approaching $1,030 paid at the moment of acquisition before a single ounce has appreciated in value. Maryland, Vermont, Maine, Hawaii, and California each apply meaningful taxation to bullion at purchase. State legislatures across the country are watching Washington. The exemption map is changing. The framework has been assembled with deliberate care and over considerable time, and we have, as yet, described only its first layer. Among the instruments of American fiscal governance, few operate with a more elegant indifference to human awareness than the mechanism known by the acronym IRMAA, the Income-Related Monthly Adjustment Amount. It does not announce itself. It does not require your comprehension in order to function. It was designed within the Medicare premium structure to adjust costs upward when a beneficiary's income crosses certain established thresholds, and it does so with a feature that makes it particularly consequential for silver investors. It operates on a 2-year delay. Here is the precise architecture. Medicare determines your Part B and Part D premium adjustments, not from your current year's income, but from your modified adjusted gross income reported 2 years prior. The standard 2026 Part B monthly premium stands at $202.90 per person, the base figure for most enrollees. But once modified adjusted gross income exceeds the threshold established for your filing status, premiums increase through a tiered surcharge structure that the agency applies automatically without explanation to the beneficiary about which event in their financial history triggered the change. For single filers in 2026, the IRMAA surcharges begin when modified adjusted gross income exceeds $109,000. For married couples filing jointly, the threshold opens at $218,000. The annual surcharges that follow run, per person, from approximately $1,148 at the lowest tier to nearly $6,900 at the highest, and those figures are per person. A married couple, both enrolled in Medicare, who sell a substantial silver position this year and push their combined income past the joint threshold, could be looking at more than $13,000 in additional Medicare premiums. Arriving in 2028, not on this year's tax return, not in any document connected to the silver sale, on a Medicare statement 2 years from now, with no label identifying where the change originated. This temporal dislocation is the mechanism's most consequential practical feature for precious metals investors. By the time the surcharge arrives, the sale has been settled, the proceeds spent or reinvested, the tax return filed and largely forgotten. The connection between a silver transaction in 2026 and a Medicare statement in 2028 is not self-evident. Income from every source, wages, dividends, capital gains, silver, contributes equally to the modified adjusted gross income that Medicare reviews. The IRS does not flag precious metals specifically. It simply processes a number, applies the schedule, and adjusts your premium automatically. Return now to the retired stacker described in Part 1, because his experience merits the full examination it deserves. 12 years of accumulation, eagles, generic rounds, 10-ounce bars from multiple dealers, assembled with the patient consistency of someone who had formed a clear and reasoned view about the dollar and its long-term trajectory. His silver position had grown to approximately $80,000 at current market prices. When the price moved this year, the decision to liquidate felt considered and timely. He sold through a familiar dealer, received his check, and approached the tax question with what he regarded as realistic expectations. He expected a bill near $12,000. He considered himself prepared. His actual bill came to $23,000. Here is precisely how the arithmetic arrived at that figure. His silver gains, added to his other income, pushed his total for the year into the 28% collectibles bracket. His cost-basis documentation was fragmentary, metal acquired at coin shows through smaller dealers over more than a decade without systematic record-keeping. His tax preparer, working with what could be proven and required to apply conservative estimates where documentation was absent, produced a demonstrable gain that was larger than the actual gain, because the actual gain existed only in recollection rather than in evidence. And because the combined income crossed the IRMAA threshold, his Medicare premiums will increase in 2028, a consequence he has not yet been notified of, which will arrive as its own separate and baffling surprise. He committed no fraud. He made no reckless decisions. He sold silver without knowing the specific rules that governed the sale, and the distance between what he expected to owe and what he actually owes is $11,000. Quantifiable, specific, and entirely preventable for those who understand the landscape before entering it. If you are watching this video with a silver position of any meaningful size, what you have just heard is not a theoretical concern. People are receiving bills like this right now, in 2026, in amounts that differ substantially from what they planned. The tax and reporting environment surrounding physical silver has become more structured and more automated than at any point in living memory, and the people most likely to be harmed by it are not the careless ones. They are the careful ones, the ones who planned, who stacked deliberately, who made rational decisions for rational reasons, and then arrived at the exit without a complete map. If this discussion has given you information you did not carry into it, subscribe to this channel right now. Every week, this content delivers the specific, documented details about taxes, Medicare rules, retirement regulations, and government systems that protect people who have spent a lifetime building something worth protecting. Not generalities, not approximations designed to avoid discomfort. The precise information that separates a clean exit from an expensive surprise. Subscribe, because Part 3 contains the legal strategies that can materially reduce what you owe, and they only help the people who encounter them before the sale, not after. The government, as more than one generation of citizens has observed, does not rely on your awareness of its systems to ensure that those systems function. The only variable is whether you arrive prepared for what those systems will extract. The most elementary concept in the silver investor's tax landscape is, paradoxically, among the most frequently neglected, and the consequences of neglecting it arrive with a mathematical reliability that no amount of good faith can absorb or mitigate. The concept is cost basis, what you paid for what you own, reduced to its most fundamental components: the date of purchase, the quantity acquired, the price per ounce paid, and the fees and shipping costs associated with the acquisition. Simple arithmetic applied to records any prudent person might reasonably maintain. And yet the cost basis trap has claimed a substantial portion of the gains of investors who were otherwise careful and disciplined in everything except this one category of documentation. The mechanism of the trap is not complicated. When silver is sold at a gain, the taxable event is the gain itself, not the gross proceeds. If you paid $20 per ounce for silver that you sell at $33, your taxable gain is $13 per ounce. The 28% federal collectibles rate applies to that $13. In a position of several hundred ounces, the difference between being taxed on $13 and being taxed on the full $33 is the difference between a manageable obligation and a devastating one. The protection that accurate cost basis provides is real, substantial, and significant, but it exists only where documentation supports it. In the absence of documentation, the IRS extends no presumption of a high basis. It extends no presumption at all. If you cannot prove what you paid, the determination may proceed from the full sale proceeds, rather than from the gain alone. Every dollar received becomes potentially taxable income. The protection simply does not exist for those who cannot demonstrate it. The 2026 revision to Form 1099-B instructions adds a dimension to this vulnerability that did not exist previously. Dealers are now directed to attempt cost basis reporting alongside sale information in filings where records permit. When a sale generates a 1099-B, the form submitted to the IRS may carry a cost basis figure sourced from the dealer's own records. If that figure and your personal documentation produce different numbers, or if you have no documentation with which to confirm or contest the dealer's figure, the IRS automated matching system will observe the discrepancy. A system running continuously against millions of transactions will flag what it finds. The resulting inquiry arrives without emotion and without flexibility, and resolving it without documentation is an exercise in negotiating from weakness. What your records must include is straightforward to describe. For every acquisition, the date, the product type and description, the quantity, the price per ounce paid, the total transaction amount inclusive of all fees, and a dealer name or invoice reference wherever one exists. For inherited silver, the applicable basis is the fair market value established at the previous owner's date of death. The stepped-up basis the code provides to heirs, which eliminates for their purposes any gain accumulated during the original owner's lifetime. For silver received as a gift, the basis is generally the donor's original cost, making the donor's records directly relevant to your own tax position. Every piece of documentation you can recover today, from old confirmation emails, archived receipts, or bank statements, represents concrete, quantifiable protection when the sale eventually occurs. A second reporting channel has emerged entirely outside the traditional dealer network and surprised more than a few investors who did not anticipate its existence. Digital payment platforms, PayPal, Venmo, eBay's payment infrastructure, and comparable services now file Form 1099-K with the IRS when transactions cross applicable thresholds. If you have sold silver through an online marketplace or peer-to-peer payment platform, reports may already have been filed documenting the proceeds, with no involvement from any coin dealer. The platform reported the income because the statute requires it to. The IRS received the report regardless of your awareness. The automated matching system then compares those platform filings against your submitted return. Where funds arrived from platform silver sales and no corresponding transaction appears on your return. The system identifies the gap and generates a CP 2000 notice, the agency's mechanism for communicating that a discrepancy exists and an explanation is expected. In the absence of a satisfactory response, the assessment proceeds, accompanied by interest and penalties running backward through the applicable limitations period. In 2026, the IRS operates 3 parallel reporting streams for precious metals activity: Dealer 1099-B filings, Platform 1099-K filings, and bank reporting requirements for large cash transactions. All 3 feed into a single automated matching architecture operating without pause. The assumption that a sale conducted outside a traditional dealer relationship is therefore unobserved rests on a factual misunderstanding of how the current reporting infrastructure functions. The digital footprint of precious metals transactions is substantially larger than it was 5 years ago, and it is not contracting. Having mapped the full dimensions of the landscape, consider the legal strategies: IRS-sanctioned, code-compliant, and available to those who plan in advance, that can materially reduce what this framework extracts. The self-directed Roth IRA represents the most structurally powerful option available. Physical silver meeting a purity standard of 0.999 may be held within an IRS-approved self-directed individual retirement account, provided a qualified custodian and depository are engaged. Within that structure, silver appreciates without triggering the collectibles rate. Within a Roth specifically, qualified distributions in retirement are entirely tax-free. A silver position that doubles in value inside a Roth generates no federal tax liability on the gain. The 28% rate does not enter the calculation. This is available to virtually any taxpayer with earned income, and its advantages over unshielded physical ownership are substantial and permanent. Timing offers a second avenue. Spreading silver sales across multiple calendar years, rather than liquidating a meaningful position in a single tax year, can manage annual income below the thresholds that activate higher collectibles brackets and IRMAA surcharges. It requires planning rather than impulse. For those who can exercise that flexibility, the arithmetic savings are real. American Silver Eagles carry a specific characteristic within the current 1099-B framework. Dealers are not automatically required to file a report on Eagle sales regardless of quantity. This does not modify the investor's personal obligation to report and pay taxes on any gain. It does, however, affect the automatic information reporting footprint of the transaction, a consideration for those attentive to what trail their activity generates. For seniors who hold silver and do not require liquidation during their lifetime, the step-up in basis at death is the most efficient tax outcome the code provides. Heirs receive inherited silver with a basis established at fair market value on the date of death. Gains accumulated over a lifetime of ownership are, for the heirs' purposes, eliminated. The code provides this. It is not a circumvention. It is a deliberate legislative feature, and it rewards patience of the most permanent kind. Finally, and without qualification, engage a certified public accountant with actual experience in precious metals taxation before liquidating any significant position. Not a general preparer, not a software program. A professional who understands the interaction between collectibles rates, holding periods, IRMAA thresholds, cost basis requirements, and the reporting framework surrounding precious metals in 2026. The difference between a return that accounts for these factors and one that does not is, in most cases, larger than the professional's fee by a meaningful margin. The entire rationale for holding silver, the complete justification for 12 years of patient, deliberate accumulation, was the protection of something earned through discipline and labor. The tax code will collect its portion from those who did not plan around it, and it will do so with a precision and patience that rewards only those who arrived equally prepared. Now, I have a genuine question for you, and I want you to answer it in the comments below, because the conversation that happens there is as important as anything in this video. Which element of this picture surprised you most? Was it the 28% collectibles rate, the number almost no one in the silver community discusses openly before a sale? Was it the IRMAA surcharge, arriving silently on a Medicare statement 2 years later with no visible connection to the transaction that caused it? Was it the Washington state change, 40 years of protection eliminated in a single calendar year? Was it the digital payment platform reporting, filing forms with the IRS with no dealer involvement whatsoever? Or was it the cost basis trap, the quiet, unforgiving arithmetic of records not maintained? Tell me which part of this you are walking away with that you did not carry into it. The answer tells me what this community most needs to hear next. And remember, this is for education and discussion only, not personal financial advice.